Did the big, beautiful bill just improve your tax situation for 2025? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about all the tax provisions that were implemented in the Big Beautiful Bill and see if they might have any impact on your retirement future. Don't forget to hit those like and subscribe buttons down below the screen. They're doing that might have a positive impact on your retirement future. And let's go ahead and get started on this one, Garrett. A lot of changes here in the Big Beautiful Bill.
Yeah, a lot of changes in the Big Beautiful Bill. Normally when we do these Vault episodes, we try not to have too many papers in our hands, but this is hot off the presses, folks. So we just wanted to go through the main points of at least the tax implications of the Big Beautiful Bill. So
coming to us in real time.
So the first one I have here, Brice, is the marginal tax brackets are extended for now. So why don't you give us a little bit more kind of details and color on that? What do they mean by the tax brackets being extended?
So in Trump's first term, they made some tax bracket adjustments, but they were set to expire at the end of 2025.
Yeah, I think they were the talking heads would throw around the point they're due to sunset.
There you go. Okay, sure. They were going to sunset in 2025, which means they would have reverted back to the pre-Trump era tax brackets.
Correct.
But what this Big Beautiful Bill did was it made these current tax brackets, quote unquote, permanent for now. There's no sunsetting on them, at least. And just to help you out, we'll throw up right here. Boom, there it is. The current tax brackets, and that is for the single, the married filing jointly, the married filing separately, and the head of household. You can find what you think your income is there and get an idea of what tax bracket you fall into. Just so everybody understands this, because Garrett, you and I see a lot of people who have a misunderstanding of this.
Right.
Let's say you're filing single and you made $48,477.
Mm-hmm.
That does not mean you fall into the 22% tax bracket because of that. But keep in mind that tax bracket starts at $48,476, which means you only paid 22% taxes on $2.
Right.
That does not mean your entire income was suddenly kicked up from 12% to 22%. A lot of people don't know that.
Yep.
So just because you're in the 22% tax bracket, as you can see here, a majority of your income would have been taxed at the 10% or the 12%. So you got to keep in mind, what is your effective tax rate? That would be weighing all those accordingly. So somebody in that situation would probably only be in about the 6 or 7 or 8% tax bracket.
Exactly.
Or not tax bracket, effective tax rate. So there's yours. Go ahead and pause it on the screen wherever you see it there and just get an idea of what your tax bracket might be. But these are what are now going to be, quote unquote, permanent.
Yep, absolutely.
Okay, so that's the tax brackets.
Yep, and so the next one that comes up is the standard deduction that the Trump administration has kind of tried to steer the majority of tax filers to utilize the standard deduction and get away from a lot of people having to itemize.
Itemize, right.
Apparently, the standard deduction is made permanent. Now, I'll use the air quotes there, but made permanent, so as far as the results of the Big Beautiful Bill.
Yeah, again, something else that was set to sunset. You and I saw from our positions here at the Wealth Guardians that once the standard deduction was raised, again, during the first Trump administration and the tax laws that they changed then, a lot more people were using the standard deduction than who previously were itemizing.
Right.
And so that's probably going to continue to be the case now. So again, the change there is only that it is now permanent, quote unquote.
Yeah. And and the idea was just to try and simplify the tax process for the majority of Americans.
Exactly. Yep. All right.
Okay. Number 3 here, major changes to the state and local taxes. The abbreviation you may hear is SALT. So major changes to the SALT cap price.
So I'll just read this here. You can now deduct significantly more state and local taxes on your federal return than you could under the previous law. This only applies to people who itemize their deductions, though. So you don't get that if you are using the standard deduction. So that now might kick a few more people back to itemizing when they otherwise would have done the standard deduction. That's only if you were paying a lot in the taxes up to that point. But now there's going to be a lot more, as I said, a lot more people itemizing, or there may be a lot more people itemizing than who had previously just done the standard deduction. However, that there's a $10,000 limit on what you can claim on the state and local taxes.
Yeah, exactly. And I think this applies to a lot of folks who might live in an area that's kind of known for having kind of higher state or local taxes. Like if you live in Boston, Massachusetts,
the Northeast,
Chicago, or New York,
New Jersey.
Yeah, exactly. Those folks are probably maybe appreciating the big, beautiful bill a little bit.
Yeah, exactly. Yep. Okay. Very good.
Number 4 here, I've got the senior citizen deduction. So this is an interesting one.
This is a very interesting one. So you know that they were promising that your Social Security would no longer be taxed. Well, what this is kind of the answer to that. Your Social Security is still going to be taxed. However, what they have done is they've given you an additional $6,000 deduction if you are 65 or older. Now, this one's not permanent. This one is set to sunset in 2028. But it really doesn't have anything to do with Social Security because you could be 65 and not file for Social Security, or you could have been 62 and filed for Social Security. Right. This only applies to people who are 65, whether they filed for Social Security or not.
True.
But in effect, if you have taken Social Security and you're paying taxes on it, this $6,000 deduction would kind of make up for you being taxed.
Yeah, it's an attempt to offset.
It's an attempt to offset it. Well said. Yeah. Okay. So that's that. But again, not permanent.
Right. Yep. 2028. Apparently that does sunset.
Yep.
Next up here, Brice, number 6, we've got bonus depreciation for small businesses and landlords.
Yeah. So if you do have your own business or you do have some rental income as a landlord, there's now a 100% bonus depreciation that applies to qualified business or rental property purchases made on or after January 19th. So if you purchased it before and you already had it, sorry, but if you're now purchasing it, there you go. I have no idea why it would be January 19th of all things. Why not January 1st? Kind of odd.
I don't know. Is that the day that Trump got into office was the 19th of January?
I don't think so. I think that's in late February.
Yeah, I'd have to go back and see whenever that took place. Last one we have here, Brice, is just kind of a catch-all of random little features of the big, beautiful bill.
Yeah. Some small ones here.
Yeah, let's go through some of these smaller ones because some of them are interesting and of note. So
yeah, so the first one is charitable giving. Normally, if you took the standard deduction and you had donated $5,000 to your charity of choice, you didn't get to deduct that unless you were itemizing.
Right, because you opted for the standard deduction.
Right. Well, now you can, up to $2,000 if you're married or $1,000 if you're single. If you made that donation to a qualified charity, you can now claim that on top of the standard deduction. Okay. So for those who are charitably inclined and they're taking the standard deduction, that helps them out a little bit. Yeah.
Fair enough.
All right. And next one would be auto loan interest deduction. So this is also above the line, which means on top of the standard deduction. This applies, Garrett, this is interesting. You go ahead and say this part here. This applies to what cars?
Yeah, so this is an interesting one. I think this is kind of more the Trump administration's attempt to kind of quote unquote buy American.
Yeah.
So you do get an additional auto loan interest deduction. So if you purchase a car and you financed
it
and you've got interest on that loan, you can deduct the interest off of your loan, but here's the catch. The car that you purchase must have final assembly in the United States.
Which, you having been in that field, that doesn't mean it's just a manufacturer like BMW. BMW, right. Some of their cars are finally assembled here and some aren't. Yes. So it doesn't matter what the manufacturer is. You have to ask the salesman, is this car I'm about to buy, is the final put together here in the United States?
And that's true. Like even like Toyota, BMW is one that we had talked about previously on the radio show. They do have some U.S. plants, but not all of their makes and models of cars have final assembly in the United States. So you may be thinking, oh man, BMW is a German manufacturer. This doesn't apply to me. Well, it might if that particular model has final assembly in the U.S.
Yep. Very good. All right. So that's kind of nice for us. That would say if you weren't going to finance it, but now you get to deduct the financing charges or the interest. Yeah. Why wouldn't you finance it at this point, right?
That's it.
Go ahead and have your money work for you. Pay 0%, basically.
Fair enough.
All right. And the next one here, the EV credit giveaway. If you were ever curious why Elon and Trump might have been a little bit at odds in recent news cycles, here's your answer.
Yeah.
The EV credit's going away, Garrett.
Yeah. So previously, for many years now, and this spans back, the previous Trump administration, the Obama administration. It used to be that at the federal level, you got a tax credit effectively for purchasing an electric vehicle.
Knock the price way down on those.
Yep, it knocked the effective price way down. Now you still had to pay the upfront ticket price or the sticker price on the window at the purchase of the car, but then you got to deduct that one time in your first year of ownership at the federal level. Now, certain states had additional kickbacks as well and additional deductions at the state level, California being the most, I guess, generous there, if you will. But basically, this eliminates everything at the federal level.
Okay.
And so it doesn't matter what type of electric vehicle you have. If you got, an EV from Rivian or you got one from Tesla, all that goes away.
Right. All of it goes away. Yep. Okay. So it might cost you a little bit more to have an EV now.
That's right.
A little less benefit. All right. Yep. And another one, no tax on tips. So that was one of the campaign promises from both sides there. They were not going to tax your tips anymore. That is true, but only up to $25,000. So if you made $26,000 on tips, then assuming that you're reporting it all, then that last $1,000 you would have to pay taxes on. But okay, so that's a little bit of a nice one. And the last one we'll talk about is the slight increase to the child tax credit. I know that that's a huge one because that changes a little bit every year.
Yeah.
Anyway, with just like so many other things, how much you can contribute to your IRA, et cetera.
Yeah, but they are going to give you a little bit extra in that child tax credit per child.
Right. So, exactly. Yep. Okay. Well, I think that that pretty much wraps it up. Garrett, did you have anything else to add to the big beautiful bill?
No, I mean, we wanted to get just kind of our thoughts and initial kind of capture of at least the tax implications of the big, beautiful bill. And I think you summed it up nice, Brice.
There we go. All right. Well, very good. That's going to wrap it up for this episode. Don't forget to hit those like and subscribe buttons down below the screen there. I'm Big Beautiful Brice.
And I'm Big Beautiful Garrett.
And this has been The Vault. Hey, it's Brice Payne with the Wealth Guardians. Thanks for watching our weekly series, The Vault. Do you know we also have a weekly radio show where we discuss all things retirement? You can listen to the Wealth Guardians radio show live on 94.5 WPTI in the Triad on Saturday mornings. But if you missed the live broadcast, you can also catch it on our YouTube channel or find us on your favorite podcast platform each Saturday morning. Make sure to subscribe wherever you listen so you can get notifications when we release new episodes. Want you to remember, good retirement plans do not create themselves. We'll talk to you soon.